Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We've got a really complex, almost contradictory set of sources today. We're pulling insights from the big ones, CNBC, Reuters, Bloomberg, Yahoo Finance. Our mission for this deep dive is try and figure out this strange market paradox we're seeing. Like, why did Wall Street stocks hit record highs Monday?
Why?
And then almost immediately, Asia slipped today. We need to kind of untangle these different stories around geopolitics, big tech earnings, the Fed decision. It's all happening at once this week.
That paradox is really the key thing to grasp right now. You had the S&P 500 closing above 6,800 Monday. First time ever.
Incredible.
Yeah, riding this wave of hope, mainly about a U.S.-China trade truce. But then you look east, and it's Tuesday morning, totally different mood.
Completely different.
Asian markets, Japan's Nikkei, South Korea's Kospi, China's CSI 300, they were all down. Broadly lower. It suggests some deep caution is setting in, not just pure optimism.
That divergence is just massive. So what's driving that? Is it skepticism about the trade truce actually meaning anything substantial?
I think that's exactly it. The market's sort of being pulled two ways by these huge forces this week. First, you've got the high-stakes geopolitics. The U.S. president's touring Asia, right? Leading up to that really critical summit with President Xi. And second, you have these massive domestic drivers. The Fed meeting wrapping up Wednesday. Plus, we are smack in the middle of big tech earnings season.
Right, and those earnings are expected to set the tone for months.
For the next 6 months, easily, yeah.
Okay, let's maybe unpack this, starting with the diplomacy. That seemed to set the positive tone for Wall Street initially. The president started in Tokyo, met the new Japanese PM, Sanae Takaichi.
Yeah, she's the first foreign leader he met since she took office.
So what was the strategic importance there? Beyond just, friendly photos.
Well, sources reporting to Bloomberg and Yahoo Finance suggest this meeting was deeply strategic. They signed documents on trade, sure, but also, crucially, on critical minerals and rare earths. Okay?
But the real kicker, Japan immediately announced plans for this massive $550 billion investment vehicle,
Right.
specifically for U.S. projects.
Wow, $550 billion. What's the strategic point of that number? It's huge.
It's a huge immediate signal. It's about geopolitical decoupling, essentially, and shoring up supply chain security.
Right.
The focus is very clearly on national security sectors, energy, AI, critical minerals, areas where relying on, let's say, rivals is becoming a major risk.
Right.
And we're talking commitments from Japanese giants like SoftBank Group, Westinghouse, Toshiba Corp.
And that energy piece sounds particularly significant, especially linking into future tech needs.
Oh, absolutely.
Yeah.
Westinghouse, for instance, they have this projected $100 billion piece. It's focused on building large nuclear reactors, the AP1000s, but also these small modular reactors, SMRs.
SMRs, right. We keep hearing about those. Yeah, and you need to remember that term. They're smaller, kind of factory-built, scalable reactors. They're seen as essential for providing that localized, guaranteed baseload power. Think massive AI data centers, defense sites.
Okay. So reliable, 247 power.
Exactly. It's not just selling power, it's about securing sovereign power supply. And Takaichi also pledged to fast-track defense spending, which the president praised publicly.
That focus on critical minerals then leads us straight to the U.S.-China situation. The anticipated summit in South Korea on Thursday. Hopes for that deal really drove Monday's rally, didn't they?
They did.
But what are the realistic expectations here, especially given how cautious Asia seems today?
Well, what's interesting is that the negotiators, according to reports from places like CNBC and Bloomberg, they seem to have aimed for what analysts are calling the low-hanging fruit.
Okay, just lower the temperature a bit.
Exactly, just calm things down. Treasury Secretary Scott Bessent, who apparently mentioned in an interview, and this is kind of funny, that he's literally a soybean farmer.
No way.
Yeah.
Really?
Yeah. He indicated China might ease its sort of unofficial boycott of U.S. soybeans. It's a weird little detail, but it shows how, grassroots some of this high-level trade stuff can be.
That is a great anecdote. But, okay, for the tech markets, the big deal must be the rare earths delay, right?
It's huge. Sentimentally, yeah.
Right.
But strategically, it really just buys some time. Sources like Yahoo Finance and Bloomberg are confirming China's expected to delay its strict December export curbs on rare earths by a year.
Okay, 1 year.
1 year. And that matters because these elements are fundamental for robotics, defense, and China processes, nearly 90% of the world's supply?
90%. Still dominant.
Hugely dominant. And there was also reportedly a deal on fentanyl, which might lead to removing that 20% import surtax on Chinese goods.
Okay, but hang on. If all they really agreed on is soybeans, and a one-year delay on rare earths. How is the U.S. market hitting record highs? Doesn't Asia's caution kind of reflect that the fundamental problems are still there?
Yeah. That is the core tension right now. U.S. officials apparently made it crystal clear that rolling back U.S. export controls on semiconductors, the heart of the tech competition, was completely off the table.
Right. No movement there.
No. So the bigger structural fights over state subsidies, tech transfer, national security, they aren't being resolved. They're just being kind of kicked down the road.
Okay.
Asia seems to be reacting to that underlying reality, while Wall Street is maybe celebrating the short-term win of no new immediate tariffs.
Got it. Okay, let's shift gears then, directly from those geopolitical minerals to the AI revolution. Because the demand for those inputs and the energy to run the AI, it's completely rewriting the rules for infrastructure. OpenAI's warning sounds pretty stark.
It was. They delivered this very blunt warning to the White House. CNBC reported on it, essentially saying the U.S. needs to massively ramp up energy investment to keep pace with China in AI.
Keep pace. How far behind are we?
Well, they urged the U.S. to commit to building 100 gigawatts of new energy capacity annually. To give you some perspective on that electron gap, China added 429 gigawatts last year. The U.S., just 51.
Wow, that's a huge difference. 429 versus 51?
It is, and their filing used this really powerful phrase, electrons are the new oil.
That says it all, really.
Right.
Why is 100 gigawatts the magic number? What's so different about AI's power needs?
It needs guaranteed baseload power. It has to be 2047, high density, and ideally carbon-free. That's different from older data centers.
Right.
And you see this playing out in big tech's energy strategy now, especially the pivot towards nuclear.
Ah, like that Google deal?
Exactly. CNBC had that striking example. Google partnering with NextEra Energy to bring back the Duane Arnold Energy Center. That's a 615-megawatt nuclear plant in Iowa that actually closed in 2020.
Bringing it back online just for Google's AI?
Essentially, yeah. By 2029, Google will buy power from it specifically for its AI infrastructure. And you see Microsoft, Oracle doing similar things. They need guaranteed power that, frankly, solar or wind alone can't provide reliably at the scale needed for training these huge AI models.
This whole boom, of course, has led to just staggering valuations, which leads everyone to ask, are we in an AI bubble? Cathie Wood talked about this at the Future Investment Initiative, the FII, in Riyadh.
She did, and she gave a very nuanced take to CNBC. She flatly rejects the idea. It's a bubble in the classic sense. She argues the long-term economic shift justifies the valuations eventually.
Sounds like a but.
There is. She also predicts a reality check, or she used the word shudder. A shudder in markets when interest rates start to rise and, liquidity tightens up.
Okay.
That could hit current tech valuations, at least temporarily. So it's this tension, right? Long-term bullishness versus maybe some short-term cyclical financial pain.
I appreciate that distinction. Long-term value versus short-term market wobbles. Where does she see the biggest actual opportunities within AI itself?
She's still incredibly bullish on hardware and what she calls embodied AI. Specifically, she highlighted humanoid robots, things like Tesla's Optimus.
Humanoid robot.
Yeah, calling them the biggest of all opportunities. She sees them as essential for solving labor shortages. And that focus, of course, ties right back to the huge demand for critical components, rare earths, everything we were just talking about.
And speaking of Riyadh, where that FII conference was held, that location itself is relevant, isn't it?
Yeah.
Saudi Arabia is making huge bets on diversifying away from oil.
That's the crucial context. Saudi Arabia's investment minister told CNBC that 50.6%, over half of the Saudi economy, is now completely decoupled from oil revenue.
That's a significant number.
It really is. And they're pouring capital into AI, building massive data centers. They have these aggressive plans for tourism, too, aiming for 10% of GDP by 2030. And this whole strategic shift requires materials for that new infrastructure. Which is why, according to reports, mining execs are seeing phenomenal interest in rare earths, specifically coming from the Middle East now. They need to build their own supply chains for their tech ambitions.
Okay, let's pivot now to some corporate milestones and the immediate market drivers for this week. Jim Cramer weighed in on who hits $1 trillion market cap next.
Yeah, Cramer, talking on CNBC, he ranked JP Morgan Chase as the favorite to get there first, ahead of Oracle, Walmart, Eli Lilly.
JP Morgan. Interesting. Why them?
Well, JP Morgan's currently around $836 billion market cap, but he called the stock ridiculously cheap.
Okay, ridiculously cheap. What does that actually mean for listeners? That's kind of jargon.
Right. It boils down to their valuation ratio. JP Morgan's trading at roughly 15 times its expected future earnings. Now, compare that to many of the big tech names we mentioned. They might be trading at 35, maybe 40 times earnings.
Ah, I see. So relative to its earnings, it's much cheaper.
Dramatically undervalued, Kramer argues, for a company that size and, frankly, that reliable. He thinks if it just gets a little bit of what they call multiple expansion investors deciding to pay a bit more per dollar of earnings, it wins that race easily.
Got it.
Oracle, for context, is close behind at $802 billion, even with that huge $300 billion OpenAI cloud deal.
But here's where it gets really critical for the short term.
Yeah.
The flood of big tech earnings actually hitting this week.
Yeah, Kramer really stressed this. The results from the mega caps, Amazon, Apple, Meta, Microsoft, Alphabet, they will absolutely define the market's direction for the next few months.
Because they're such a huge part of the index.
Exactly. Collectively, they make up almost 35% of the S&P 500's value, according to sources like Yahoo Finance. So as they go, the market tends to go.
Right.
And on a related note, Reuters reported Amazon is apparently getting ready to announce its biggest layoffs ever, potentially affecting up to 30,000 employees.
Wow, 30,000. That's huge.
It is. And we also saw Novartis shares take a hit. They actually had strong Q3 growth, but missed net income estimates right after announcing that massive $12 billion deal to buy Avidity Biosciences. CNBC covered that.
So lots of moving parts in corporate news, too.
Yeah.
We're also seeing some interesting institutional moves in crypto pointing towards more mainstream acceptance.
Definitely seeing that trend continue. Reuters reported that KR1, a British crypto firm, announced plans to uplist to the main market of the London Stock Exchange. That's about getting major institutional eyes on them.
Okay.
And maybe even more significantly, Citigroup and Coinbase are partnering up. They're looking to provide digital asset payment solutions specifically for institutional clients, exploring things like stablecoin conversion.
So this isn't just retail trading news.
Not at all. This is about the basic plumbing of big financial institutions adapting to handle digital assets. It's quite fundamental.
Okay, let's wrap this up with probably the single biggest financial event of the week. The Federal Reserve's rate decision. Their two-day meeting ends Wednesday. What's the market expecting?
The consensus, looking at CNBC analysis and futures markets, is it's almost a certainty they'll announce a 25 basis point rate cut. That would be the second cut this year.
Right.
And it would bring the federal funds rate range down to 3.75% to 4.00%. The really interesting strategic question, though, is why cut now? Is it purely about domestic economic signals slowing down? Or is the Fed maybe reacting partly to that global caution, the trade uncertainty, the stuff that seems to be worrying Asian markets? That's less clear.
And for you, the average person with loans or credit cards, what does a Fed rate cut actually mean in practical terms?
Yeah, it's important to manage expectations here. A Fed cut hits short-term, variable rates most directly, things pegged closely to the prime rate.
Credit cards.
Exactly. High-interest credit cards, home equity lines of credit, HELOCs, maybe some adjustable rate mortgages, ARMs. You should see some adjustment, probably within a billing cycle or two.
But not a huge drop.
Probably not. Experts usually caution that, card rates won't go from awful to amazing overnight. And longer-term loans, like your standard 30-year fixed mortgage, they're much less sensitive to the Fed's overnight rate.
Right. Tied more to bond yields and inflation outlook.
Precisely. More closely tied to Treasury yields and broader economic expectations.
Okay. So pulling it all together, we've got this record high market rally, but it seems based on somewhat temporary trade optimism. You've got AI demanding a total rethink of our energy grid.
Yeah.
And the Fed is easing rates, maybe partly due to global jitters, just as big tech reports earnings that could swing everything. It's a lot.
It is a lot. The synthesis is kind of that the market's standing on this underlying structural conflict, the tech competition, the supply chain scramble, but it's being momentarily boosted by expanded Fed liquidity and, relief from that temporary trade truce.
Right.
So the fundamental question for you to really think about is this. Given that the U.S. and China only really managed to agree on that low-hanging fruit soybeans, a one-year pause on rare earth curbs, will that rally momentum hold up once investors fully digest that the core conflicts, like tech export controls, are still completely unresolved? Or will the sheer weight and anticipated earnings power of big tech, remember, those companies are 35% of the S&P 500, Would that be enough to just carry the whole market forward through year-end, almost regardless of how these trade fights actually play out? That's the real tension to watch in the coming weeks.
That is a phenomenal question to chew on as we head right into the thick of this earnings season. Thank you for diving into the headlines with us. We'll see you all tomorrow morning with new headlines from major financial magazines.